Markets have some clarity now on the Trump administration's tariff plan, and it has sparked a global sell-off. Joining us now for Perspective is Michael Craig, Managing Director and Head of Asset Allocation and Derivatives with TD Asset Management. Michael, we've been waiting for this. We have the information. Clearly, there is a reaction in global markets. How are you reading all this?
Well, you know, there's two takes on it. There's the take you're hearing today, and it's just, this is crazy, and it's going to lead to kind of global recession. Our sense is that this is kind of Trump to a T in terms of asking for the world as a starting point of a negotiation. Interesting yesterday that Mexico and Canada were not mentioned because our tariff negotiations are far more advanced as we were the first countries to kind of get hit. And so I think that this is the beginning of a negotiation. 10%, which is the baseline, is probably the floor, and the current levels are probably the ceiling. There is risk that you get, countermeasures by countries. There's a lot of kind of rhetoric, and this is for domestic electorates. When you actually look at the bargaining position, it would be pretty dangerous to reciprocate, just because the impact they're able to do on the U.S. economy is far less than what the Americans can do to them. So my sense is we'll start to see some negotiations. It means tariffs ultimately are going to come into play at some level, but not at these levels. But obviously right now the market has been caught offside, and there's been a material sell-off. Again, on the year, not massive. U.S. stocks are down 7% on the year. Canada maybe a bit better than that, but it is certainly leading to a lot of uncertainty in the markets right now.
If this is the opening round of negotiation to start to see country by country trying to negotiate, would we expect more volatility going forward? I just think about the amount of headlines that we're just inundated with all the time on this.
I would, yes, for sure. I don't think this is going to be dealt with overnight. Our sense is we'd like to see progress certainly by June and absolutely by September, such that it doesn't start to really filter it into decisions that CFOs and companies are going to be making in terms of capital allocation. That could be a really negative long term if you start to see this drag on and companies really shy away, and then that starts to create a bit of a vicious circle. So the next 6 months are critical, and ultimately it's. But we would expect to see some negotiations happening right away.
When we talk about capital allocation when it comes to investing, obviously think about equities, fixed income, alternatives. I want to sort of go through those buckets in terms of what we're going through right now, where we hope to end up. And let's start with equities.
Broad, it's fairly negative across the board. What's interesting with equities, there are some longer term implications. We're seeing it in our own country as the discussion within our own election is really about investment and infrastructure and whatnot. And various countries are going to have to look at rejigging their economic model away from exports to either consumption or investment. That is bullish. And so, the next little while is going to be very messy. But longer term, we would be optimistic that equities will be just fine as you're going to have actually positive fiscal impulse ex-US around the world in terms of reorientating their economies away from supplying goods to the U.S. market. So this will take time, but that backdrop I think is bullish for the global stock markets. The other thing I have to say is the dollar is overvalued. Many currencies are undervalued. Today's reaction is interesting. The dollar is really under pressure, particularly against the euro and yen, but also against Canadian dollar. My sense is this is the beginning, perhaps, of a longer-term, challenging or bear market in the U.S. dollar, as money gets repatriated in order to spend on things I talked about. So it's an interesting backdrop. It is we've had this era of exceptional U.S. outperformance. I think we're going to start to see a bit more, much less dispersion of returns, or even a reversal where other markets are outperforming the U.S. market. So that's something to think about for investors who are, for the most cases, overweight U.S. assets but underweight kind of global stocks.
What about fixed income in this environment? Is it going to do its job?
In Canada today, it's actually not. Canadian bonds are modestly better today, but really only a few cents. Asian markets are quite strong. Europe is okay. And the U.S. bond market is really rallying, although you're giving it all back because of the currency. I think the market's sniffing out fiscal expansion, and so curves are steepening. Longer-term debt is not performing nearly as well as shorter-term debt. We are pricing in more potential cuts in the U.S. market. We still have a couple priced in Canada. I think that is fair. But I am concerned about that longer debt trajectory, and so fixed income has been okay this year. It's positive, but there are some headwinds looking at the fixed income markets, particularly in Europe, if they do start to really follow through on fiscal expansion. Same for Japan.
In the traditional portfolio, we've covered the two big ones, equities and fixed income. Hearing a lot of discussions, though, around alternatives. What do we think about alternatives in this environment?
Yeah, so we've been using more alternatives over the last few years. They are exactly environments like this where they really do shine. Not all alternatives are made equal, and so when you're thinking about alternatives, it really got to think about how it improves the overall diversification in a portfolio. So things like infrastructure, real estate, commodities, mortgages are some of the things that we use. They're really creating an improved diversification profile for clients, and like candidly, right now we're in a bit of a fog. I mean, I can give you my opinions, but tomorrow it might change materially based on what happens. This is what it is. The real advantage we can have is by using better diversification to work through these environments and have overall drawdowns reduced.
Is that the real key takeaway in turbulent times like these? In the end, as an investor, you need to think about diversification.
You need to think about diversification, and then like investing is it's a long-term endeavor. I mean, all of us kind of invest through our lives, and through a lifetime, you're going to have euphoric days when things are way too good, and you're going to have horrible days when they're horrible, like today. It's really that destination of where you're going and ensuring that your portfolio is built to get to where you're trying to achieve, whether it's capital appreciation or living off your wealth or what have you. Everyone's situation is unique. So days like today, while are upsetting, and look, people are facing not only a tough day in their portfolios, but many are worried about their employment. So this is not a great backdrop for people right now. My hope is that this is the peak of it, at least on the tariff side, and that we've got better days ahead, particularly in terms of how the country is shifting towards more of a growth mindset.